start the. So we will be recording the session so that we can come back to it if we would like. And I'm going to start by introducing the team here at the REC, who can then introduce our guest speaker today. And I'll start by introducing one of the students who's an intern at the Regional Entrepreneurship Center at Miramar, who's Angela Merkins, and she's going to tell us a little bit about what we're going to be doing today.
Okay. Hello, everyone. Thanks for joining us today. My name is Angela Merkins, and I'm
vitamins came so quickly. Gosh, so many things
at the Innovation Lab at Miramar College. And tonight we're going to have our speaker here, David Ferran. I hope I said that right. Sorry, David. He's a board member and founder of the CEO of the Torrey project. After a 35-year career as a senior executive in a fiercely competitive semiconductor industry, David has had a chance to reflect on process of starting and building and leading and buying and selling high-tech companies. And throughout his career, David has been the CEO of multiple companies, both public and private, as he founded companies working at cutting edge of science and technology, and has been managing director of an investment banking advisor firm. Yeah.
Oh, I was just going to say you were cutting out a little bit there.
David has.
Oh
no. Okay.
Oh, no, it's okay. I can hear you now, but I just wanted to make sure. David, does it sound about right? Is she hitting the nail on the head with that introduction?
It's absolutely fine.
Okay. Cool. Wonderful. Awesome. All right, go ahead, Angela. I think I can hear you now.
Thank you. David,
and she's cut out.
Has also served as a board member of a global nonprofit. Am I back? Sorry, global nonprofit that's dedicated to feeding the hungry and serving the needs of both here in the United States and around the world. And as president and CEO, chairman, and board member of member of multiple public companies, David has seen the dark side of today's version of capitalism in action. He has been the power of the marketplace and unintended, but cast drops against consequences of chasing short-term quarterly returns at the expense of employees, customers, supply, society, and the planet. David will share how the Torrey project is.
Oh, I'm sorry. We're going to stop right there, Angela.
What was that, Tanya?
Oh, no, it's okay.
Okay,
we're going to stop right there and then have David kind of explain a little bit about that, about how he'll be doing that. So, David, awesome. Maybe you can tell us a little bit more about what Angela started with and explain how you've changed things at the Torrey project.
Sure. Anyways, so as all of you just heard, my name is David Ferran, and I'm currently working with Torrey Project here in San Diego. And at the Torrey Project, we are working to accelerate the adoption of a much more socially responsible form of capitalism in the world. And we're doing that because we are deeply, deeply concerned about global issues like environmental degradation and social injustice. And
David, can I interrupt you right there? And maybe this would be a good time for us to share the poll and see where the audience.
That'd be great. I would love to know where you guys are starting the conversation.
Let's start here. Let's go ahead and look and see where we have. So, can everyone see those results? About 76% of the respondents have never even heard of stakeholder capitalism.
Okay, so what I'm seeing is that 90% of the audience is interested in joining or leading a startup, and all 100% of those folks at least are going to need to raise capital. But most of you don't know what shareholder primacy is, and most of you don't know what stakeholder capitalism is. So you are exactly where I was when I was getting ready to start my first business. We are right in the same place. And I just pray that after our conversation today, it's not going to take you 40 years to learn what I learned. And you're not going to make as many mistakes as I made, and you're not going to do as much harm to the planet and society as I did. So it looks like we've got a good conversation tonight, and really, I'd like it to be a conversation. And I have a tendency to build up a head of steam when I get talking because I'm passionate and I care about it. And people sometimes are afraid to stop me, but please don't do that. If you've got something to say, I want to hear it. If you've got a question, I'd like to try to answer it. But then again, you may have information that answers my questions. And so everybody on this call or this meeting today has something to offer. And I want to just encourage anyone and everyone to speak up, speak out. And if I say something that you don't understand, ask about it. And if you disagree with me, please, please, please disagree. I would love to mix it up. And so push back. And, you know, let's see if we can keep this from being a boring meeting and turn it into something that might be useful. Sound good?
Yes.
All right. Okay, so as I said, I'm working with Torrey Project now, but that's not where I began. And I don't like to talk about my past to brag or to boast. And so I don't really want to talk about all the great things I accomplished in my life. Frankly, you can read about that online. It's not really that important and it's not that impactful. I started my first business the year I graduated from college. And I didn't start it because I wanted to start a business. I really didn't. I mean, my plan when I got out of school, I was going to travel the world and I was going to follow the snow because I was a big skier and I was a bartender, and I was going to teach skiing by day and I was going to bartend by night. And I was just going to go northern hemisphere and southern hemisphere, and that's what I was going to do. And during my senior year, my father got fired. My father's a scientist and a brilliant, brilliant, brilliant man, not a good businessman, and had problems keeping jobs because he had a tendency to not get along with his employers. So he lost his job, and he informed me that we were going to start a company together. I was like, no. And long story short, next thing I knew, instead of being a bartender and a ski instructor, I was CEO of an equipment manufacturer making high-tech instrumentation for the semiconductor industry. And so at the age of 23, I raised my first $1 million of venture capital. And I didn't know that I couldn't raise $1 million worth of venture capital at age 23, so I did it. And I just went to Silicon Valley, and I literally went to Sand Hill Road, and I knocked on enough doors until the VC gave me my money. What I didn't realize, I thought I just sold 20% of my company. Actually, I sold my soul, and I didn't even know it. Because when I raised my first $1 million in venture capital, the VC came onto my board. They recognized that I had not a clue as to what I was doing, and they were very kind. They taught me how to run a business, and they taught me very well. What I didn't realize at the time is they were teaching from the Bible of shareholder primacy. And what I saw from the poll today is most of you don't know what that is. I certainly didn't know what it was, and frankly, I didn't know what it was till a few years ago. So don't feel bad. But the book that they taught me from, Shareholder Primacy, that was a theory, and it was an approach to capitalism that was promoted by probably the most famous economist in the world back in the 1970s. His name was Milton Friedman. And actually, he wrote a lot of the textbooks on economics that I studied in college. And so Milton Friedman was asked the question, what is the purpose of business? And he was so fascinated with it, he wrote an op-ed for the New York Times in 1970 that literally changed the world. And the op-ed in that article, what he said is the purpose of business is to maximize return to the shareholders. That's the purpose of business. And he did say that it had to be done within the bounds of laws. So it was not okay to break the law to maximize the return to the shareholders, but everything short of breaking the law was the job of the officers and directors of companies, was to do whatever they could do within the law to maximize the return to the shareholders. And some people asked, but what about the employees? What about the customers? What about the supply chain? What about society or the environment? And he was very clear on that it was not the role of business to deal with those sorts of issues. That business only had one purpose, and the one purpose was to maximize the return to the shareholders. That approach to capitalism became known as shareholder primacy. And as you can imagine, shareholder primacy simply means that shareholders reign supreme. They are above everybody else. The needs of the shareholders matter. The needs of everybody else don't matter. And so he championed the concept of shareholder primacy, and the people on Wall Street loved it. I mean, they absolutely ate it up. And so Wall Street said, this is the way to do business. He's the most famous guy in the world. He's a brilliant economist. Everybody needs to follow Milton Friedman's rule, and shareholders matter. Nobody else, nothing else matters. And it was embraced. It was embraced by Wall Street. Most importantly, it was embraced by the investment community. And so the investment community came to think that that's the way business should be done. And that's what they expected. And in fact, that's what they demanded. So in order to build a business, in order to run a business, you need capital. The people who control the capital here in America, by the way, around the world, but I'm going to limit my comments tonight to America. The people that control capital here in America that you need if you're going to start a company or back in the 70s, they were all subscribers to shareholder primacy. So my venture capital investors took me under their wing, and they taught me how to maximize the profits and how to maximize their return on their investment in my company. And they taught me how to do that by laying people off, cutting wages, closing down business units, whatever it took to cut corners, cut costs, and boost profits and increase the shareholders' return. They taught me how to do it, and I got really good at it. I was absolutely ruthless, and I was able to go out. By the time I was 29, I raised enough money to go out and buy my first public company. And I took over a public company, and I broke it up, and I laid off a lot of people, and I stripped out expenses, and I closed down divisions, and I sold off product lines, and it was all hugely successful. And as a result, I was able to combine the company I bought with the company that I started on the dining room table, and I was able to do an IPO, and we went public on the NASDAQ, and we were very successful. And we went out and we did a secondary offering, and we raised more money because I had a number of other acquisitions lined up. And I needed the cash. So we had all this cash on our balance sheet, and we were really profitable, and we were growing. And the semiconductor industry is a cyclical industry, and it went over the top. And the analyst said that there was going to be a downturn in the semiconductor industry. So all of our publicly traded stocks went down. And when the stock price went down and we had all this great performance and cash on the balance sheet, we were ripe for hostile takeover. And indeed, we were one of the well-known hostile takeovers that happened here in San Diego back in the 90s. And my company was taken over by a multi-billion-dollar company that did the same thing to about 40 other companies here in America, just capitalizing on an opportunity coming in. And so you would think that because my company was profitable and we had lots of cash and we were growing and our customers loved us, you would think that we could have said to those people, no, we don't want to sell now. this isn't a good time to sell. Our stock price is going to go back up. There's nothing wrong with the fundamentals of the business. And so, no, thank you, we won't sell. But there's that shareholder primacy thing, and it reared its head. And my director said, but they're offering more than the stock is selling for today. Don't we have a fiduciary duty to our shareholders to accept this offer? Because they can get a higher price today by taking this offer than they could if they sold it on NASDAQ. They could get more profit, so we should take it. And I said, no, we shouldn't. And so we brought in one of the top law firms in the country that specialize in this, and they said, yes, you have to take it. It's just the way it works. And so I lost my company. And one would have thought that I might have learned a lesson by that, but I didn't learn any lesson at all. I was just really kind of unhappy. Let's just use that as a term. I was unhappy because I lost my company, but 8 weeks later, I was recruited by another publicly traded company to come in and do a turnaround of their business because they were in deep trouble. And I came in and I laid off people and I cut wages and I slashed budgets and I killed product lines and I closed down divisions and I turned that company around. And then I was recruited by another public company and I did it again. And after doing all that damage, I decided that there was a lot of money to be made in this. And I got into mergers and acquisitions and I started a company. And for 11 years, I worked with the people on Wall Street doing that at scale, working on billion and multi-billion-dollar deals where it was all about extracting value, not creating value, not sharing value, extracting value. And so that's my sordid past. And that's where I lived for a long time. And I'm deeply, deeply ashamed of it. And the reason I'm doing what I do now with Torrey Project is because it's time for me to make amends. I really, really got it wrong. And I may have made a lot of money from my family, my shareholders, investors, but I really look back at what I did in my life and I have deep, deep regrets. And I hope that as a result of this conversation today, some of you who are going to be powerful forces in the world are going to be forces for good. And you'll take a look at your business a little bit differently. So that's one big, long verbal puke. Any thoughts or questions or anything you want to talk about that before we move on?
I have a question.
Sure.
Hi, my name's Karen. I've been with the rec for a couple of semesters now. And first, I want to thank you for sharing because it definitely is something that obviously takes a lot of courage to admit that you feel like you've made a lot of mistakes in your past. And even though it's gotten you to where you're at today, I'm sure you wish you might have wanted done things differently. My question to you is that although, like you said, people adopted that method of shareholder primacy, I guess my question is, for the entrepreneurs and the CEOs that are trying to scale to that large of a company now, is there really any other way? And is believing that there is any other way kind of a fool's belief? Because at the end of the day, if we want to do good, which we're all here because we do want to go do good, when you're trying to scale and the shareholders and the people that want to invest and that want a piece of your pie all have adopted that mentality, I mean, it's almost kind of like you're backed into a corner. And is there really an alternative?
Great question. And the reason it's such a great question is that the answer has changed recently. If you had asked this question 20 years ago, I would have said no. I would have said nope. If you want to raise big ticket money, if you want money from venture capitalists, if you want money from private equity, if you want to take your company public here in the United States, you must embrace shareholder primacy. To suggest as CEO of a company that you were going to take a different approach 20 years ago would have had you fired on the spot. There was no room for the kind of thinking that we're going to talk about today. But there's been some fundamental shifts that literally have the potential to change the world. But the only way it's going to happen is if people like you know about it and people like you embrace it and you bring it forward in the world. I'm not going to live to see it happen, right? This is going to be a slow, multi-generation change. When Milton Friedman wrote that article that set capitalism off on this catastrophic course, that was exactly 50 years ago last month. So we've been screwing it up for 50 years. We're not going to fix it in 5 years. People ask me, how long is it going to take? If everything goes the way that you're suggesting, David, how long will it take? First thing I say is I'm not smart enough to know. Second thing I say is if I had a bet, I bet you it's going to take at least 2 generations to get all the way back. And I want to challenge you guys to make me wrong. Do it in 1 generation, right? But we have really made a big mess, and we've gotten, my generation, my father's generation, we've gotten us so far off track that you guys have a hell of a job left, right? But let me tell you how you can do it, right? Because there's good news, right? There's really good news. So the first thing is what you asked about was really the capital markets, right? What you're asking about is if you're an entrepreneur and you want to build a business, one that's going to really grow and scale, you need capital, right? And let's talk about the stack of capital if you're an entrepreneur. Most entrepreneurs start with seeking capital from their friends and family, right? And that's normally the first round, it's friends and family. I call it the friends and family and fools round, because anyone who is not your friend or your family and gives a early stage entrepreneur money is a fool. And that's just the way it is, because the risks are enormously high, and the risk adjusted returns are just horrible. So the first place you go is to your friends and your family. When you can't grow any further and you've tapped out your friends and your family, you go to the angels, right? And you ride the angels as long as you can ride the angels, and then you go to venture capitalists. And you ride the venture capital train as long as you can until the next round. And in the next round, for some lucky companies, like I was very lucky with my first company, I was able to go from venture capital to publicly traded. Very often, there's a private equity step along the way. And so it's venture capital and then private equity and then your IPO, right? Well, on those stacks, angels were always rather reasonable because they were people and they could be dealt with. But as soon as you hit the venture round, sorry, shareholder primacy rules supreme. And forget about it when you get to private equity. They're even worse. And of course, NASDAQ and the New York Stock Exchange, they don't want to hear about anything other than shareholder primacy. So you couldn't have done it before. But what's happened? What's happened is the angels who act more like people are becoming more aware of the societal impact of capitalism that's gone astray. So angel groups are starting to become much more socially conscious. They're more aware of the impact, the social impact that the entrepreneurs they give their money to are going to make. So angels are coming along, and that's a good thing, right? But remember, the angels, they don't make a profit until your stock is sold and they get a return. And very few companies are going to go angel and then cash out. There's usually that venture capital step. So if the angels think that you're promoting an approach to business that the VC won't buy, it really kind of gets in the way of them saying yes. So you need venture capitalists who are willing to provide money. And the VC community, until recently, was absolutely not open to it. I will tell you that in the last 5 years, there's been a shift, and venture firms are now starting to set aside some of their money for socially responsible companies. And it's still a small minority of the money, and it's what I'm advocating to become the vast majority of the money, but it's starting to happen. So there is venture money out there today, and I'm talking about for-profit companies that are seeking to grow and scale and create wealth, right? I'm not talking about nonprofits. There is venture money for those kind of companies, but you got to look really hard. We at Torrey Project are in the process of building a network of institutional investors who are willing to invest in the kind of company that we're going to talk about today. And so we're trying to build that community. We're trying to find those investors and kind of bring them together into a corral so that when we have an entrepreneur that wants capital, if they've got the kind of business that warrants it, we can get them good capital. And so that is one of the things we're working on at Torrey Project is good capital for good entrepreneurs. We have a tendency to say conscious capital for conscious entrepreneurs. So that gets you through the venture capital round, kind of, sort of. It's getting better. Then you run into private equity. Private equity is controlled in huge, huge lumps by a handful of big players in the world that literally have trillions of dollars under management. Those guys were about as far away from the concept of socially responsible business as anything I've ever experienced in my life. But fortunately, we have the United Nations. The United Nations put together the 17 Sustainable Development Goals that I'm sure you all know about. If you don't, you should know about. And what they've done is they've said, we need the world of business to act in a way that supports the accomplishment of these Sustainable Development Goals. And so an organization was created in London called the Principles of Responsible Investing, or PRI. And so if you look up PRI in London, you will find that this is now a hugely powerful nonprofit organization that is putting the arm on the big fund managers around the world, getting them to sign a commitment to allocate a percentage, to be negotiated, a percentage of their capital for socially responsible companies. And it's having an impact. And you're starting to see the big private equity companies come on board. If you look at Larry Fink, who runs perhaps the largest of the private equity companies, he sent out a letter to all of his CEOs telling them if they didn't clean up their act and become more socially conscious, and if they didn't start addressing social issues, they were going to sell their stock in the company and they weren't going to invest in them. And boy, oh boy, when a CEO gets a message like that from their biggest investor, holy mackerel, does that carry some clout. So we're starting to see the private equity firms thinking about making investments in here and actually making investments in here, although the smaller portion of it. But then you run into Wall Street, public companies, right? I mean, that's the holy grail. If you're an entrepreneur and you really want to make a lot of money and have a lot of fun and you want to scale and you want to be global, you want to be public. I mean, it's like the big badge. It's the big gold badge of success for an entrepreneur. I was able to take my company from the dining room table to public. It feels really good. But the way that you have to act to be publicly traded on NASDAQ and the New York Stock Exchange is despicable. And that's the standard. And both of those stock exchanges have been absolutely unwilling to embrace socially responsible capitalism. They just aren't interested. It's a threat to their little monopoly. And so they have pushed back hard. But there's good news here as well. There's a gentleman by the name of Eric Ries. A lot of you might have read his book, The Lean Startup. Well, Eric decided to do something about the lack of a stock market that would allow companies to act differently. And so he decided to form something called the Long-Term Stock Exchange. And the idea was that it's the short-termism, it's the short-term thinking, the short-term drive for profitability that has caused capitalism to be such a destructive force in the world. And so what we're going to talk about next is not a new, but a different approach to capitalism called stakeholder capitalism, which really focuses on doing the right things so as to create the right result over the longer term. Well, if you're going to run your business that way, you can't be on a stock market that measures you every 90 days, right? When I was running public companies, I ran 3 of them. Every 90 days, I had to announce our earnings. Every 90 days, I had to give guidance. I had to tell the analysts, this is what we did over the last 90 days, and this is what we're going to do over the next 90 days. And that was my report card every 90 days. And believe me, if we fell short, they hammered the crap out of our stock. And guess what? My board had a really clear agreement with me. David, if you piss off the analysts, we will fire you. And I'm sorry to use that language, but that's the way it was. Right? My job was to keep the analysts happy because what the analysts wrote drove the price of our stock. And the only thing the analysts cared about was being able to prove that the report that they wrote about the next 90 days actually was right. And if I made them look bad, they punished me. When they punished me, they punished our stock. And if that happened, I lose my job, I lose my bonuses, I lose my stock options. So what did I do? Well, I am very proud to say I never missed a quarter's earnings. I always made the numbers. I kept my job. I made a lot of money. How did I make the numbers? I cut corners, right? If we had to shut down a development program, right? If I had to close down a department, if we had to not do something that would have been in the best interest of our company over the longer term, sorry, it doesn't meet the short-term needs. And that's the way we ran the company. So Eric Ries comes along and says, hey, let's get rid of guidance. Let's stop telling these clowns what we're going to do every 90 days. And instead, why don't we publish a long-term strategic plan and put it right on our website? And we'll stop telling them what we're doing every 90 days. We'll still give them our financial results. The law requires that. But what we'll do is once a year, our board will write and publish and post on our website a report on the job that management did over the past year on accomplishing the long-term goals that are set out in the long-term strategic plan. So once a year, you update your strategic plan, you share it with your employees, and once a year, the board actually rates the performance of management in terms of how it did on the major elements of the strategic plan. And it's a beautiful way to run a company. So it took Eric, one would think that he would have gotten a standing ovation and the long-term stock exchange would have been, born instantly. Instead, it took him 8 years of fighting the SEC and overcoming unbelievable opposition. And if he hadn't made so much money in his career, and if he didn't have so many rich buddies from Silicon Valley, it would have failed. But he had the determination and he had the financial strength to persevere and to fight the SEC and to fight the opposition. And on May 10th of 2019, the long-term stock exchange was approved by the SEC. The first companies on the long-term stock exchange will probably be listed by Q1 of 2021. So it's about to happen. And the question is, will it succeed? And every one of you should be watching to see what happens with the long-term stock exchange, because it might just die, right? Wall Street's still against it. Believe me, there's still a lot of opposition. People are still trying to keep it from succeeding. And we'll see if they have the clout to kill it. But if they don't, what it means is that for you young entrepreneurs, there's a chance for you to get your capital from socially conscious and aware and supportive angels, and then to find those venture capital investors, the few that are willing to invest in value-aligned companies. And you can get value-aligned venture capital, which in my world has been an oxymoron. And then you could go to one of these nice private equity companies that's trying to put more money into socially responsible companies, and ultimately you could go public on the long-term stock exchange. It's a stretch right now. I'm not going to tell you that this is easy and that it's all set up, and if you want to do it, you can do it. What I'm saying is that theoretically, there's a path forward. Theoretically, you guys can do this, right? Now, you got to have good businesses. You need to have a really good plan. You have to have a good value proposition. You have to have a good team, right? There's a whole bunch that you got to have. You got to bring the fundamentals to the table. But if you bring the right fundamentals to the table, and if you are aware of the difference between investors that want to invest in shareholder primacy companies versus investors that want to invest in a stakeholder capitalism company, if you're aware of that difference, and if you just refuse to take money from the wrong places, you can do it. So that was a very long answer to your question, Karen. I'm sorry.
No, it was very informative. Yeah, I have a lot of questions, but I'm gonna hold off until maybe the end.
Yeah, and please always feel free to reach out to me. I'm easy to find. I'm at Torrey Project, and so I'm always available, and I love to talk about this stuff. So does anybody else dare ask a question after that long-winded answer? Okay, maybe I've just beaten you all to submission.
Do we have any questions also in the chat, maybe, Angela? Or
It does look like there might be one. It says, any views from David about the phenomenon SLAC?
Would that possibly be SPAC?
It was
Whoever asked the question,
yeah.
Is it possible that you were asking about SPACs or SPACs?
I don't know.
Yes, David. Sorry, it was a typo.
Okay, no problem. So, because no, I hadn't heard about SLACs, but I have heard about SPACs. And in fact, back in 2003, I came really close to doing a $300 million SPAC IPO. And unfortunately, we were in the pipeline to get our deal done when one of the big SPACs blew up, and it absolutely wiped out the SPAC market for about 15 years. It's back now. So yes, I know about SPACs. SPAC stands for Special Purpose Acquisition Company, and essentially, it's a way of getting around doing a traditional IPO. So if you've got a company and you want to go public, there's a process known as the initial public offering, or IPO. And boy, oh boy, is that a painful process. Going through the IPO roadshow, when we did it, literally, I had to fly around the world making presentations, and literally every day in a different city for 2 weeks. And you go through that, and you've got the auditors up your nose, and it's a very lengthy, very expensive, very tedious process. And it's such a horrible process that people would love to be able to become a public company without going through it. So along comes the idea of a SPAC. And with a SPAC, what you do is you go to Wall Street, you say, what I want to do is I want to take this vehicle public, and it doesn't have any business at all. But what we're going to do is, after the public shareholders give us the money, we're going to go out and buy a company, and we're going to merge the company into this public shell. And it's a way of, so what you do is you find a private company that wants to go public, but doesn't want to do an IPO. And then you do a SPAC, and you take the money you got from your SPAC IPO and you give it to the company, and you buy the company and you merge it into the publicly traded SPAC. And then you change the name of the SPAC to the name of the company. So it's financial engineering, and I can tell you the money that the Wall Street folks make on those is shocking, which is why I was doing it.
I've got a question.
Sure.
This is Brennan. Hey, thanks for presenting. It was really interesting. So 2 questions. During your story, you were saying like at one point you wanted to, I think you wanted to not sell, but like it sounded like board members wanted to sell or something. And then you reached out to a law firm and you found out that you had to sell. I was curious what happened there. Like what was the requirement that kind of forced the selling?
Sure. Yeah, it's a great question. And I better plug my computer in.
Second question, short one is, I'm just curious. I heard you say to reach out to Wall Street, and I've always heard people say that, and I've never understood what that meant. Like, what is Wall Street kind of?
Okay, yeah, it's a bucket term, right? There's no precise definition, so let me answer that one. People tend to refer to Wall Street as the home of institutional capital. Now, the truth is, of course, the institutional capital doesn't live on Wall Street, but that's where the big financial brokers and stock markets and kind of the nucleus of the financial community was on Wall Street. And so the financial community spoken of at large is very often referred to as Wall Street. So that's that one. And then your first question, when you asked about, what was going on at the board level, it was really interesting because there's a myth out there, and you're going to hear this. I heard it and I believed it. So let me tell you what it is so that you don't believe it. There is a myth out there where people believe that if you are an officer or a director of a company, you have a fiduciary duty to maximize the return to the shareholders.
That is a pervasive myth.
Yes, and I'm here to tell you that it is absolutely not true. You will not find that as a written law anywhere in anything in the United States. It's not true. And that doesn't matter because it's the rule of the game. It's the rule they play by. It's not a law. But it's the way the game is played. And it's the way everything's set up. And it's the way that the precedent has been set in the legal cases. So what our law firm was, what our board was saying when they found out about it is the first thing our board members said, at least a vast majority of them, there were a few that had different agendas, but the good board members all said, we don't want to sell. We don't want to sell, but we have to sell because we have this fiduciary duty, and this price they're offering is above the price of the stock, and there's enough of a difference between the price they're offering and the price of the stock, so we have to take it. And so that was their feeling. So we brought in the law firm. And what the law firm said is, well, you don't have to take it. You could say no. But you realize that as soon as these guys made the hostile takeover offer on you, the price of your stock went up. And so people have been buying it at a price just under the hostile takeover price. And if you deny the offer, your stock price is going to go down. And when your stock price goes down, the shareholders who lost money on your stock are going to sue you. And now they may not have enough money to really make your life difficult, but the company that wants to take you over is going to join the lawsuit because they have shares too, right? They bought your stock before they announced the hostile takeover. So they will join the lawsuit And what they will do is they will just keep litigating you until you either agree to sell or you go out of business. So you're in a death trap, David, and there's no way out. And so we ended up having to sell our company. And I think we're almost, so Tanya, is this over at 6:30? Because I want to touch on stakeholder capitalism. Is it 6:30, the end of this?
We have,
Okay.
yeah, I believe
All
it's,
right. So
yep,
we've got
6:30.
10 minutes, and if you don't mind, I'm going to pivot us to stakeholder capitalism because I really want you guys to know what it is. And once you know what it is, I encourage you to study it and pursue it and learn about it. I'm learning about it, and I am on fire. It is just so cool. So stakeholder capitalism is pretty much the opposite of shareholder primacy. Stakeholder capitalism requires that as a leader of the business, you know who your stakeholders are. And stakeholder is a term that is totally misunderstood. It's used by way too many people to mean way too many things. So I'm going to give you David Ferran's definition of stakeholder. A stakeholder is anyone or anything that is impacted by the operation of your enterprise. Got it? Anyone or anything. So let's talk about the anyones. The anyones are your employees. They're your customers. They're your suppliers. They're your business partners. They're your shareholders, right? Those are all impacted by the operation of your business. So what are the things that are impacted? Well, how about the environment? It's a thing, and boy, oh boy, is it an important stakeholder. What about society at large? That's a stakeholder. We impact society by the way we run our companies. Look what we're doing to society by the way we're running our companies. Look at the incredible economic divide, the difference between the haves and the have-nots, the incredible, difference between the highest paid and the lowest paid people, right? People worth $100 billion in paying their employees less than a living wage. That impacts society, right? So society is a stakeholder, right? The communities we do business in are impacted. Are we a good influence and a good force in our community? Are we supporting our local organizations? Or are we just taking? Are we polluting? Right? What are we doing? So that's what I call stakeholders. So as an entrepreneur, you got to know who your stakeholders are. Then the next step is when entrepreneurs come to me with a business plan, the first thing I do is I ask them if they have a plan, a financial plan. And they always do. They always have a financial plan. I say, great. So you've got a plan for one of your stakeholders, your shareholders. Where's your plan for your other stakeholders? And typically they look at me like I have 6 heads. What do you mean? Most of them don't know who their stakeholders are. Once they figure out who their stakeholders are, I start asking, what's your plan? They don't have one, right? If you want to be a force for good in the world with the way you build your business and grow your business, know who your stakeholders are and put as much work into figuring out how each and every one of your stakeholders is going to benefit by the operation of your business before you start your business. Have a plan. Put it in your business plan. Tell your investors how your stakeholders are going to win while they, as shareholders, are winning. You're all going to win together. And don't believe people when they tell you you can't do it, because you can. So in stakeholder capitalism, the challenge to the officers and directors of companies is to fairly and equitably balance the return to all of their stakeholders over the longer term. And that over the longer term is that's the key to this whole thing, right? Because on any given day, you can't possibly optimize every decision for every stakeholder. I mean, sometimes there's just a give and take in things. When you pay more to your supplier than you have to, you're taking away from profit that would have helped your shareholders. So your supplier is better off but your shareholder's worse off, right? Well, if you always did what was good for the shareholder, you'd kill your supplier. If you always did what was great for the supplier, you'd kill your shareholder, right? So you don't. You have to balance it. But how many of us are parts of families where we have to balance what we have in our family? We've got a family budget, right? Some of the money is going to be used to pay the rent. Some of it's got to be put away for junior's college education. Some of it has to go for Susie's, braces, right? There's short-term needs. There's longer-term needs, right? There's things you want to do. There's things you got to do. Well, running a business is just like that, right? The reason it works in a family is because the heads of the household truly care about every member of the family, right? And they're in it for the long term. They know their sons and daughters are going to be their sons and daughters 20 and 30 years from now. So they act accordingly. If you believed that your stakeholders were still going to be your stakeholders 20 to 30 years from now, you would act different than the way people typically act when they're running companies here in America. We treat everybody as they're disposable. We can screw a supplier because there's another one that'll take the business. We can lose this customer because there's another one that we can convince to buy our products. We can burn our people out because there's a bunch of unemployed people that would take the job at minimum wage. That's not the way to do business, right? So it's a whole new mindset. There are a number of names for what I'm talking about, and I just want to share them with you so that you're not confused by it. You'll hear people talk about conscious capitalism. Conscious capitalism is a brand. It's a trademark. It's owned by an organization. It's a great thing, right? Conscious capitalism is stakeholder capitalism. It's just the name is owned by an organization. So I don't say conscious capitalism because that's somebody else's brand. Stakeholder capitalism is not owned by anybody. It's just what it is. It's based on stakeholder theory, which has been broadly developed, promoted, and written about by Dr. R. Edward Freeman of the University of Virginia. So any of you that are interested in learning about stakeholder capitalism, go to R. Edward Freeman at Darden School of Business at University of Virginia. This guy he's written books, done videos. There's a new movie out on the subject. If any of you want to watch, you got 70 minutes and $4.99, you can watch this movie. It's called Fishing with Dynamite. It's the whole story of how capitalism went off the rails and how stakeholder capitalism is going to save the world. Watch that movie if you want. It's called Fishing with Dynamite. It's available on Amazon. You can rent it for $4.99. So conscious capitalism is a term you'll hear. Stakeholder capitalism is a term you're going to hear. Accountable capitalism, you're going to hear. ESG, environmental, social, and governance capitalism, you're going to hear. Those are all essentially different flavors or different names of the same thing. It's where you care about the impact on all of your stakeholders and you run your business for the good of all with a long-term perspective. And with that, it's about 6:30. If there's anything else I can or should do for anybody, please always feel free to reach out to me. I'll put my email in the chat for you. And we don't charge for anything we do at Torrey Project. We are here to be of service, and we want to change the world, but we're not going to live long enough. So what we're going to do is teach you how to change the world. So.
Thank you, David. Thank you so much. That was great. I really appreciate that. And I watched that movie at your recommendation. It was really good. So thank you. If you guys get a chance, definitely watch it. And we also have David's information in the Rec Connect platform, so you guys can find it there. And Emma just made a little announcement. Don't forget to fill out the feedback form. So if you could, actually, if you want to just save everything that's in the chat, I realized long ago that everything disappears in a chat as soon as the meeting is over. But a way that you can save it is if you just click on the chat And then you see those three little buttons at the bottom, side by side. If you click on that, you can actually save the chat so you don't lose everything that's in there at the end of a meeting. I found that's been useful.
Yeah, that was a great hack when I learned that. It actually, I couldn't find it though. I saved it and then I couldn't find it. And then someone told me what it does is it creates, at least on my computer, a folder in my C drive set that says Zoom.
Yeah.
And it saves all the chats in there.
And so then you can go back through all of them. It's wonderful. Yeah. So wonderful. Again, David, thank you so much for coming. That was a really great workshop. So important, I think, especially where we are right now in our history. So I really appreciate you coming, and I appreciate that. And thank you all for joining us. We will see you again at the next workshop of the REC, and have a wonderful evening. Thank you for being here.
Thank you all. It's been great.
Oh,
All right.
if anybody wants to still do a photo, I completely forgot, but if you're still here and want to do a photo, I'm going to take a picture. So turn on your camera.
Email in the chat.
What's that?
I'm missing it.
Karen, what was that?
I said I don't see David's email unless I'm missing it.
Oh, David, did you put your email in the chat? Or,
I did.
He did. Let's see. Yeah, so it should be there in the chat. Let's see here. Yep, right there. Oh, you put it to me privately. That's why. I'm going to share it with everyone.
No, I did.
Okay.
Let me see.
No, you put it for me, David. Okay, so I'm going to go ahead and
I
take a picture. If you guys wouldn't mind smiling, I'll do a picture in 3, 2, and 1. Cheese. Wonderful. Thank you so much. I appreciate that.